Hi everyone, Sean here to talk about financial markets, intermediaries, and institutions. So I want to let you know that Lori put together this wonderful PowerPoint that I'm going to get to present to you. So kudos to her and thank you for putting it together. So we did this in the intention of to get you guys ready for terms that you might not be familiar with. If you are, then this might be a breeze, but we definitely want to make sure that you're understanding the concepts of the difference between markets, intermediaries, and institutions. So our first slide, it all starts with savings. So where can we put our money? Well, one of the spots we can place it is into a bank account. So I'm sure this is one that you are all familiar with. You go to your local bank, you say, hey, I want to open up a checking and savings account. I'm going to put my money in there. I may not get anything on my checking account, but on my savings, I might earn something. So you might see some cents or some dollars accruing over the time that you place money in that savings account. You're also probably familiar with maybe a CD or a money market. Those pay a little bit better, but this is something that you're going to go to a bank and say, I want to open this and this is what I want. And that's going to help you deposit money into a bank. The bank will then turn around and use your deposit in any way they want to, as long as they are fulfilling the requirements that the cash reserve requirements set forth by the government. And as we know, FDIC insurance, they insure a lot of the bank deposits, and that's why the government also puts reserves on these banks. Another place that we can put our money is the stock market. So, you might have an E-Trade account or any of those other interfaces where you can go online and start buying up equities or mutual funds or whatever it may be. This is showing that you have a partial ownership in that company. So we're purchasing. Normally, it's if you're investing for yourself, it's going to be through the secondary market, which we'll talk about later. But you're going to be buying, say, Apple stock at $300 and something per share, and for that one stock, you're going to be a 0.00001% owner of that company. But you are still an owner, and you still have voting rights based on being an owner. So when we talk later, we'll talk about other investors that might have more influence on how a company is run based on how they raise capital for their firm. Another thing that you can put your money is in life insurance, or we buy insurance over our cars, our house. There's a lot of different types of insurance, but for the sake of this example, we're using life insurance, and the return that you get back is a payment upon your death. So you buy a life insurance policy on yourself, which someone else will be the beneficiary, and that life insurance company is going to do the same exact thing with the life insurance policy. So you're paying for this life insurance policy. They're going to reinvest your money. So there's even more capital out in the market. So just by you purchasing a life insurance policy means the life insurance is going to go out and invest in something else, which maybe that is raising capital for someone else. So you can see the cycle of funds. And that's kind of what the point is we're trying to make through this presentation. Another thing, like I said earlier, in stock, the exchange is the E-Trade account or whatever it may be, mutual funds. So you could buy a mutual fund. And a share in a mutual fund is you're getting a share of a wide range of securities. So you might buy an S&P 500 mutual fund, and it's a mutual fund that purchases all the stocks on the S&P 500. The hope is that when you buy it, you can sell it later for a gain. And this is just a good way to diversify your portfolio. There's also things called exchange traded funds, ETFs. It acts in the same way of diversifying your portfolio. If you have questions about it, let me know. A little bit more high level than what we're trying to get to, so I'm just letting you know it's out there. And then something that you might know about from work is a pension plan or a 401k or any of the other types of retirement funds that are out there for you to participate in. I actually work on pension plans at work, so I'm pretty familiar with the way they work and the funds that they're investing in. And again, it's that the company is putting money aside into a pension plan. It's somebody's fiduciary duty to make sure that money that's set aside for your pension is invested, and they're trying to gain some sort of return so that they can pay you later on. And the 401k works in the same way, except you're making an election on where those where the investments are, because it's your contribution. It's not the company's contribution, it's your contribution, which means you have say on where you should place your money, because ultimately that's the return that you're trying to get, and that will be paid to you when you retire. So the next slide, how do your savings get to the companies who need the money to invest in operations? So we broke it down in 5 different ways. You could go directly to an investor, and there's a couple of different types of investors. There's private equity firms, there's people called venture capitalists, or even angel investors. And here's a fun fact for you. The angel investor, the origins are from Broadway. So back in the day, these Broadway shows were very risky, because you're investing in this large production and you're not sure if tickets are going to sell. So an angel investor comes in and they pay you the initial cost of setting up this production in the hopes of getting something in return, and they were called angels. So that's where the term angel investor comes from, because these angel investors today are investing in companies that are probably more high risk, and that's why you have to reach out to one of these angel investors, because they have a lot of capital and they're looking for different types of investments, maybe investments that they want to be a part of to actually facilitate how those companies are run even. So some companies will reach out to an angel investor or a venture capitalist and ask them to help them with the progress of their company as well as invest. You could also get capital through financial markets. This is usually the public companies, because you'll issue debt and stock. So you have to be public to do that. We'll get into that in the next few slides. You can get it from financial intermediaries such as mutual funds, hedge funds, and pension funds. So as in the last slide, we just described what a mutual fund and a pension fund are. A hedge fund you'll actually hear about later on in this presentation. So number 4, from financial institutions such as banks and life insurance companies, used by both private and public companies. So if I'm a private company, I don't have stock outstanding and traded on a market. I'm private. I have maybe 5 investors, so it's me and 4 other friends. We're a private company. We can look to life insurance companies or banks and say, hey, can I please get a loan from you, or how can I get proceeds from you to maybe get that project that I want going. So just another outlet of capital that we can look to. Number 5, also income earned by the firm gets put back into the company. And this is called the plowback ratio. So when you fill out your income statement, so you might remember when we did accounting, we got down to operating profit. Well, there's a few other lines under that which we didn't get into too much detail, but some of those examples are the interest expense, tax expense, which gets us down to our bottom line called net income. So net income usually goes right into owner's equity, and that's on the balance sheet. So this is just accounting terms. I'm an accountant, so I know I'm talking probably a little bit more than I have to about it. But that net income rolls into something called retained earnings on the in the equity section of the balance sheet. Now, before it does go into retained earnings, the firm can pay a dividend off of that net income. So if you pay a dividend out of net income, the retaining amount, hence why it's called retained earnings, is what will end up in equity. So we call that our plowback ratio. So our net income less our dividends that we pay out is going to be our plowback ratio. We're plowing that back into the firm. We're reinvesting capital in the firm. And why would you do that? Well, if we have a bunch of investors, they want us to maximize shareholder wealth. So a big key to know is that the number one goal of any firm is to maximize your shareholders' wealth. So what are we doing when we say, let's take our net income and roll it all the way back into our firm instead of pay out a dividend? We're telling our investors that we know that we have something better to use this money for, to get them a higher rate of return based on the new projects or the ways we're going to spend this money than they could on their own. So it's a firm decision. Let's roll it back into our company and reinvest it so that we can earn our investors more, maximize their wealth. Okay, so those are the 5 ways that we can get capital. So let's tackle these one by one. Getting money directly from investors. So a big positive of this is we get cash for our business. So we're going out there and we're asking them, hey, can I please have some of your money? Probably wealthier people, such as one of those venture capitalists, and hopefully they say, yeah, make me a whatever percent owner. But that does lead to a negative because now we have more owners having say in our company. So we also might mention it's a limited audience. So if we were to have an initial public offering, which is what we'll get into on using stocks, issuing of stock, there'll be a lot of investors, which means a lot of people are making decisions, so not a limited audience. Number 2, through financial markets. So this is what I was just talking about. How does it work? Well, we're going to sell stock to outsiders via stock markets, or if we're already public, we can sell bonds via the bond market. The positive of this is, again, we're getting cash for our business, exactly what we need. The negative is that we now have a ton of owners, and so it is a positive and a negative to having more owners because maybe more owners can help us make better decisions, or at the same time, maybe all those ideas could get, they're too divided, and it could affect us in a negative light. So for bonds, company has to pay the bondholders interest and pay back the original amount borrowed plus there may be restricted bond covenants. So when we talk about bond covenants, we're talking about when we issue this debt, there may be things in place that we cannot or we must do to make sure that we're in compliance with these bond covenants, such as they might have a liquidity ratio. So we must have so many current assets to our current liabilities, and if we fall under that, then we're non-compliant, and there might be some ramification to that. Other things are, a liquidity waterfall. So if our company is in trouble, who's going to be the first to get paid? Well, there might be a covenant saying these are paid first. So again, decisions are being made differently based on these debt covenants, which could affect us, or bond covenants as written here. It's the same thing, debt or bond. So we'll say a company issues corporate debt or corporate bonds. It's the same thing when we talk about it. 3, through financial intermediaries, mutual funds, pension funds, hedge funds. How does it work? Well, the intermediary sets up a fund that is owned by lots of individuals. So think of pooling of assets. A mutual fund is huge. A pension fund is huge. Hedge funds are huge. You're talking about millions and billions of dollars. So not mom and pop trying to invest in something. So we're getting the positive is we're getting that capital that we need, and it's just like how we're doing it in number 1 and 2. There's the same negative, which is that there's decisions in place for others to make. So if a mutual fund manager has so much percent of that of our stock per se he's a 30% owner, that's a lot of voting power. So we want to take that in consideration. And the same thing for the bonds. If we issue bonds to a mutual fund, a hedge fund, or a pension fund, it's the same idea. We're paying interest and the original principal back. So same as the second one before, which is right here, the through financial markets. So going on to number 4, we can finance through financial institutions, such as commercial banks and insurance companies. So this one, we can go out to a commercial bank and say, hey, I need a huge loan. Well, they also have the capital to do so because they pool funds. So you're looking at these banks that have balance sheets that are larger than most of us can even imagine. And so it's probably a good place to look for cash. And like I said earlier, banks still do have reserve issues, so they have to make sure that they have these capital reserves in place. But at the same time, it's just a good a good place to look for cash. It works the same exact way as all the others. So if we issue stock, there's more say, and the owners have not always agree with the original owners, so that could be a negative. Um, and let's see, what else do we have? So it does say positives. The company now has more owners who may not always agree with the original owners. That should actually say negative. For bonds or loans, company has to pay back. It's the same idea. So going forward, now let's talk more about markets, intermediaries, and institutions. Well, the stock market. So there's two pieces that we really want for you to take away from this conversation or this PowerPoint. There's the primary market and the secondary market. The primary market is when we go and have our initial public offering. So I'm a private company. I'm trying to raise a lot of capital, and my decision is I'm going to have an IPO or initial public offering. So I hire an investment bank to help me go public. And when I go public, I'm issuing stock for the first time, and I'm selling that on the primary market. So if I am, I don't know, say Lululemon back a few years, and I want to go public, and I issue my IPO for $30 per share. So I sell, I don't know, they probably sold a lot of a lot of shares. So probably more than what I'm going to use for this example. But for this example, let's say I sell 1,000,000 shares at $30. I then get $30 million. Well, that stock is already out there and being was sold initially on the primary market. Now, John down the street purchased Lulu on the primary market for $30. He turns around and sells it for $45, and he has made a $15 gain on that. That $15 gain is not going to Lulu, it's going to John, because he sold it on the secondary market. So when a security is sold again, or has been sold after the initial public offering or after the initial issuance of that stock, we call that the secondary market, because none of the proceeds from that sale are going to the company that was sold. So again, if John were to purchase $30 from me or from Lulu on day one on the issuance of the stock, I'm making $30. John's out $30 because he bought, and he gets a stock certificate for one share. The next day he turns around and sells it for $45. He makes $15. I make zero from that transaction because that was sold in the secondary market. Okay. So the other markets that we want you to just know about are the fixed income markets, which are the debt securities known as bonds or corporate debt. There's money markets. There's short-term. Money markets are short-term financing. Usually, we say the rule of thumb for this is less than a year. A good example of this is commercial paper. So a lot of very large companies will issue commercial paper, which is millions and millions of dollars at a time. Like I said, these have to be large companies. And the reason why they do this is because they're exempt from SEC registration. So it's a lot easier to issue this. But on the other side, it's an unsecured, discounted promissory note. So when somebody purchases this commercial paper, so say you purchase $100 million of commercial paper, you might only buy it for $99,950,000. So you will get $100 million back when it comes due, when it matures. So then you'd make $50,000 off of it. And I use that example because, and you saw how small. So on $100 million, you might make the $50,000. That might even be too large based on the rate that you'll get. Commercial paper rates are very, very small. So another reason why companies like issuing this, if they need some capital up front real quick, they'll issue commercial paper. And the average maturity on commercial paper is 30 days. And that's another reason why the rates are so low on some of these. And also a good point to make is that companies that issue commercial paper usually have very, very high credit ratings because of this commercial paper being unsecured. So no one would want to purchase this if your balance sheet or I'm sorry, your income statement is all in the red. So, you know, you're not making any profits. There's, you know, we question that you might be able to pay this back. No one would purchase that commercial paper from you. So that's what we talk about when we say high credit ratings. Capital markets longer than a year. Uh, that's just terminology. I mean, capital markets could be your stock markets, your fixed income markets, if that fixed income security is longer, the maturity is longer than a year. Just so that's just for definition's sake. Foreign exchange, we trade currencies on the foreign exchange markets. So if you are in the U.S. and you also have a company in Switzerland, you might be trying to buy the Swiss franc, and there's also some derivatives involved with that between futures, forwards, and options, which you'll see below in derivatives. So some of these go hand in hand, but if I'm trying to buy if I'm in the U.S. and I'm trying to buy U.S. or Swiss francs, so U.S. to Swiss francs, that's the trade of currencies. We do this on what's called the foreign exchange market. There's a commodities market. This is where we go to buy and sell a lot of our tangible goods. So gold, corn, oil, cows, bacon, anything that you can think of as an actual commodity, a raw material. It's usually going to be on this market, and one of the big commodity markets is out of Chicago. So you might have heard stories about the Chicago Board of Trade and the commodities market there. So the derivatives is we have forwards, futures, swaps, and options. I don't want to get into detail about these because they are very confusing, but the big point to take away from derivatives is we're trying to reduce our risk. So when we use derivatives properly, high emphasis on the properly, we're diversifying our risk away. So we're hedging our risk, as we like to call it. But like I said, this is when we use them properly, because there's definitely ways that people have used derivatives in a very negative way, and it's affected our markets. So financial intermediaries, the goal is to raise money from investors and provide financing for individuals, companies, and organizations. So it's like any other intermediary. You will take deposits from the borrower, or I'm sorry, not the borrower. You'll take deposits from mom and dad, or your sister, your cousin, whoever it may be. You're a small bank. You take those deposits, then you help reuse those deposits and give a loan to, say, a company or another family to buy a house and stuff like that. So you can see the transfer of funds, and that's one of the biggest goals of the financial intermediary, and it helps us grow as an economy because if you lend money to a bank, so you deposit money to a bank, they can then pass that on, and then it gets passed on and redistributed further and further from there, which helps us grow as an economy. So one of the bullets here, typically a fund of some sort, so mutual fund, hedge fund, pension fund. So back into funds. We talked briefly about a mutual fund. It's an investment portfolio that pools investors' savings, and we purchase a wide range of different types of securities to give us diversification. It's low cost to us because I could buy $100 worth of one mutual fund and be completely diversified across whatever my plan of diversification is. So whether it's over an exchange, whether it's over a sector or an industry, over the whole entire market. So they have all types of different mutual funds that you can purchase. And we call it low cost is because I do not have to go and buy an individual share of all those companies. I give whatever I want, and I get everything in return. So that's how it's low cost to us. A hedge fund, it works just like a mutual fund, but there's a lot less regulation on hedge funds. It's very private. They don't have to disclose what they're investing in. And this is definitely for wealthy investors. So hedge fund managers will only seek very wealthy people to invest in their fund. Pension fund, an investment fund set up by an employer to provide for employees' retirement. I think I already hit home on this. If you have questions on pension fund, you can always ask me more. I deal with them enough. But yes, they purchase a wide range of different types of investments. And if you can think of companies that have very large companies, you can imagine how large some of those pension funds really are. I worked on one that was over $1.5 billion. So you can imagine the how many types of investments they might hold based on how much money that is. And they have to diversify themselves too because they don't want to lose money. They want to diversify to make some sort of return, but never lose because it's on the employer to contribute to that fund to make sure that your retirement is paid for. Financial institution. It's an intermediary that does not, or I'm sorry, it's an intermediary that does more than just pool funds. So we already gave you the definition of an intermediary. An institution is an intermediary. They just do more, okay? And here's the difference between a commercial bank and an investment bank. The commercial bank just raises money through deposits and loans. Investment banks, on top of that, raise awareness and advise to assist companies in raising money. So I already talked to you about, my initial public offering. I'm going to go out and engage an investment bank to help me underwrite my stock. And they also do things called, or they used to run trading floors. So a lot of what's happening today is a lot of the exchanges are going to the electronic platforms. So there's a lot less in the pit type trading. But we definitely still have trading floors on the investment banks. So our brokers are still being utilized. So, you'll have a lot of people on an investment fund floor trying to purchase and sell stock, but it's not going to directly to a one of those pits that we see in a lot of the older financial movies. Just to give you a hint on what's changing in the financial world. Next, insurance companies are financial institutions, and the reason why they are is because these two bullets, they collect premiums from policies and invest in capital and money markets. They also make long-term goals to firms, such as real estate companies. All right, so functions of markets, intermediaries, and institutions for savers and companies. 1. Create a way for money to get from savers to companies needing money. So again, this is what we're talking about. Mom and dad, they want to save some money. So they give the bank the money, hopefully getting a return. So say they open up a CD, a little bit better return than the savings account. That bank now has that cash to then provide to a company that might need it, who will invest into a project, which then that project will raise that company money, which maybe that will then go back to those that hold those stocks because they'll give them a dividend. So you can see how the transfer of money really helps our economy. Reduce risk for the saver through diversification. So again, diversifying reduces our risk, right? So if I purchase a mutual fund, if one of those stocks loses its value, so it went from $100 down to 10, I'm saved because of the other stocks that are held within that mutual fund. So when we purchase very few stocks, we're not diversified because it can impact us in two ways. It can either go up very, very high, and we can sell it at a large gain, or it could go down to nothing, which then, if we only have a couple, could really affect our pocket. But mutual funds, that risk isn't there because we're diversified over a whole portfolio of, whether it's the industry, sector. You can do U.S. exchange traded securities. You could do international funds. There's a very, very wide variety. But the big point here is that we want to reduce our risk. 3, the ability of the saver to sell or exchange investments back into cash when saver needs it. So cash is king, right? So we want to be able to get cash when we need it. And 4, generates information for the saver about what is suitable return for any given investment. So information is also a very, very important piece of this. We can signal the market in a lot of different ways. So if I'm seeing that Apple's being traded at $350 today, tomorrow it drops to $200, and other securities follow it, and all of a sudden you see the whole market starting to fall. Um, we're thinking, oh man, this is not good. Maybe I should be taking some of my money out. Or on the other hand, you see the S&P go up 100 points, or oh, that seems a bit high, maybe 20. So how about we say the Dow goes up 200 points? Well, the market looks really good right now. There's two things I can say. Maybe it's too inflated, and I should be careful about investing now, or maybe this is just the start of a very long run, and maybe I want to invest in it now. We can also say information is provided to us based on rates. So a lot of the banks will look at treasury rates to determine what rates should be on mortgages. So I used to work on it's automotive floor plan. So what happens is the bank side of it, they give loans to these large car companies that have these fleets of cars on their lots that they're trying to sell. Well, the bank will give them a rate and then say, you know what, we'll invest your fleet for now until you sell them and you pay us back. Well, a lot of the rates that they were using were the treasury rate plus maybe a little bit of a 0.25% on top of that, so a little bit of a premium. Or they use something called LIBOR plus a spread. And LIBOR is actually a very common rate that's used on in a lot of the banking world. But the information on what those rates are help dictate what rates I could even get on a mortgage or on a car loan or whatever it may be. So we look to the financial markets and intermediaries and institutions for a lot of different information, probably more than what you think on a daily basis. But just think about it next time you're sitting down trying to determine if you should refinance your house, or what that rate might be on refinancing your house, or rates in the market today. Should I invest in the market now because rates are returning 10%, and maybe I'd rather have that than the opportunity cost, which is go on a family trip. It's something like that. As simple as that, I should say. So that is the big four takeaways for the functions of these. And that's all I have for you guys on the PowerPoint. Thanks again to Lori for putting this together. Please reach out to us if you have any questions. We're glad to help. Thanks, guys.